With this lecture, we continue our discussion of the investment project valuation, and we are going to talk more about cash flow estimation. In the previous two lectures, we computed all these investment criteria, or we call them methods of making decisions. And all the time that we did those calculations, we used cash flows as given. So we knew somehow that these cash flows are such that we see in the task. But the important question is how in practice to derive those cash flows. How can we estimate those numbers? What is the initial cost? What is the annual cash flow? That's what we are going to tackle in this lecture. The general procedure looks as following. So there are several important elements in the estimation of the cash flows. So we need to estimate the investment outlays, like minus something in year 0, and annual net cash flows, as I said. Well, we are doing forecasts. We are doing this for the future. We don't know exactly what is going to be the cash flow, what is going to be the investment outlay. We just make a forecast, so we estimate it. And there are several, let's say, in any company, in any firm, you would have several departments that are responsible for different parts of those forecasts. So here, if we are talking about sales, because sales are the most important determinants of your future cash flows from the project. The sales forecasts are made by, for example, marketing group. So unit sales and sale prices. The capital outlays can be obtained from the engineering or product development staff. So those people know what is required in order to technically start the project. So it depends on the sphere. So if we are talking about some manufacturing, of course, we need to have an engineering team, and they need to know if you want to manufacture like a new brand of mobile phone, you need a specific equipment for doing this. If you are going to produce whatever, if you are going to be an IT company and produce some software, you also need to have some initial investments in computers, in the software, probably in some research and development, and that's going to be your product development stuff. Then, important part is operating costs. So together with sales, what you are going to earn from selling your product, you need to know what you are going to spend while producing this product. And operating costs might be estimated by accountants or cost accountants, depending on, again, on the size of your company. So usually in any company there is either a specific department or at least a specific person who does this cost accounting. Sometimes those are production experts or personal specialists if it goes into the salary and determining salary for the people who are going to be involved in your project. So purchasing agents, so they probably know about the prices of necessary resources, and so on. So you see that in the process, in the procedure of cash flow estimation, many different groups and many different departments are involved. So this is not a task of a financial manager. This is a task of a large team. And we need to be realistic that forecasts are usually imprecise and they would be different to the future cash flows. So what you forecast and what is gonna happen in reality might be different. Now, another important issue here is that we need to consider something that is called relevant cash flows. Relevant cash flow is the additional free cash flow that the company can expect if it implements the project. So the word relevant means that this cash flow is gonna be induced by your decision. If you decide to implement a project, something would change, and this something must be taken into account while estimating cash flows. So first point from here that we are making our decisions based on cash flows. So we are talking about cash flows, not income, especially not accounting income, and you will see why. And only incremental cash flows are relevant. So incremental means what I said. Incremental means that they are induced, or they are triggered, or they are related to your investment decision. So free cash flow is the cash flow available for distribution to investors. So what we are talking about, so the amount of money that can be distributed among investors. And we know who are investors, either shareholders or creditors. So now we will talk briefly about the procedure of free cash flow estimation that is gonna be very important for estimating cash flows and how do they differ from the income. So this is called indirect method of a cash flow estimation, and we start with something which is called net operating profit after taxes. Later I will explain you what is this. Again, net operating profit after taxes. Then we add back depreciation. We will discuss what is depreciation if you are not familiar, but probably you are supposed to be familiar because you have an accounting and financial analysis. Then after this, we subtract gross fixed asset expenditures, so the purchase of equipment, buildings, machinery, whatever. And we also subtract change in net operating working capital. And as a result, we have a free cash flow. So this is an explanation. What is the net operating profit after taxes? This is earnings before interest and taxes multiplied by 1 minus tax rate. So EBIT is earnings before interest and taxes. So, and some other explanation, FA is fixed assets and NOWC is net operating working capital. So in the next slides, we will discuss the essence of each element from this slide. Yeah, when we are talking about change in NOWC, we are talking about delta, change operating current assets and delta in operating current liabilities. So most of the next slides are gonna be devoted to the explanation of this important slide, because on this slide the whole essence of cash flow estimation is given. So how cash flow, those numbers that we use for calculating NPV, IRR, whatever, how those numbers are formally, practically computed in this way. So how do we calculate or compute earnings before interest and taxes used here in order to start our free cash flow calculation? We start with revenue, sales. That's why we need unit, sales, and sale price. We subtract material cost. So that's where we need to know the production process and what are the materials needed to produce our product. We subtract salary. And related cost. Maybe some social benefits that a firm pays for its employers. We subtract depreciation, and we subtract some other operating costs, if any. Electricity, fuel, maybe rent, maybe some package. So everything that is related to the production of and sales of your product. The result is gonna be called earnings before interest and taxes. And when we multiply this by 1 minus tax rate, we get net operating profit after taxes. So next element that influences cash flows, cost of fixed assets. What do we mean by this? First of all, when we purchase fixed assets, those are negative cash flows. Again, looking at this slide, we see that if we purchase fixed assets, this is taken as negative to the free cash flow. So what those costs include? Yeah, first of all, we need to understand that these purchases affect cash flows is the negative sign, but they do not affect accounting income. So that's why accounting income is not a good measurement for investment project valuation. Accounting income is related to these fixed asset purchases through the thing called depreciation. So depreciation is the part of a purchase price that is deducted from annual cost. Apologies. Yeah. The full cost of fixed assets necessarily includes everything that is related to your purchase, shipping, and installation costs. So that's why it is also important that we are not taking a clean price, we are taking price plus all the costs related to shipping and installation of this piece of equipment. And the full cost is used as a depreciable basis. So the depreciation used for calculating income is computed from this. For example, if you purchase a computer and invoice price is 100,000 rubles, and then there was a shipping and installation, something like software installed on the computer, and it cost in addition 10,000 rubles. So the full cost is going to be 110,000 rubles, and this cost is going to be the base for depreciation computation. Another important issue that we need to remember about fixed assets is that they can be sold at the end of the project's life. So sometimes fixed assets live longer than the project. And then when we expect to sell these fixed assets, this amount is going to constitute a positive cash flow. Now, more about depreciation. Why do we do this? So logically, depreciation is, we have two places where depreciation appears. So first of all, we subtract depreciation when calculating EBIT. So depreciation is given with minus. Then we take EBIT, multiply by y minus t. We have this NOPAT, and then we add this depreciation back. What's the logic? Why are we doing this? Why can't we just not deduct depreciation from this place? Maybe this is gonna be correct and okay. And the problem is the following. So depreciation is subtracted from revenue when we calculate net income. This is a part of cost. And therefore depreciation reduces income before taxes, and as a result it reduces taxes paid. And when the taxes paid are reduced, what does it mean? It means that the cash flow is impacted by this. So we need to subtract depreciation when calculating EBIT, because later we have a computation of taxes, and the size of tax depends on this, depends on EBIT. So therefore we cannot ignore, we cannot simply drop depreciation from the process of EBIT calculation. But on the other hand, when we want to know what is the cash flow, depreciation must not be subtracted. It's not a cash flow. Depreciation is not a payment. Depreciation is a part of our past payment for an equipment, for fixed assets. But it has nothing to do with the actual payments. So therefore we add it back while calculating cash flow. So depreciation is added to NOPAT when we estimate project cash flow. So that's why we have this complicated action with depreciation. First we subtract depreciation, then we add back depreciation. We subtract it in order to compute taxes correctly. It affects taxes, but we add it back because this is not a cash outflow. This is non-cash charge. So we discussed about fixed assets, we discussed about computation of EBIT, we discussed about depreciation. So the fourth element that is needed to be discussed in the computation of a free cash flow, it's changes in net operating working capital. What is this? In order to run an investment project, fixed assets are not the only element that is needed. We also need additional inventories. to support new operation. Raw materials, maybe. Maybe you need to produce this new product in order to have enough stock for the cases of growing demand. When we expand sales, it necessarily leads to increase in accounts receivable. So our clients owe us more. So that's why all those things, they require more money. On the other hand, payables and accruals would also increase. So payables and accruals are the obligation of our company. So we purchase more materials, we purchase more resources, we have accounts receivable. All of these lead to the opposite processes. The company starts owning more to the suppliers, to the workers, maybe to some other related parties, to the providers of electricity. And we need to consider this somehow in the cash flow estimation. So when we are talking about growth in inventories and receivables, this reduces the free cash flow because this is additional investment. So think about this. If you want to start a new project, together with equipment, you need to have some materials. Initial stock of materials. You need to pay for this. But the fact that you are able to increase your payables and accruals reduces the needed cash to finance your inventories and receivables, and therefore it increases your free cash flow. And finally, the difference between delta in operating current assets, these two, and delta in operating current liabilities, these two, payables and accruals, constitutes the change in net operating working capital, which is subtracted in the process of a cash flow estimation. Why don't we take net income to start the cash flow estimation? Why don't we subtract interest expenses when we compute EBIT? The logic is very clear. We want to have a measure of a return for all investors, because project generates cash flows available for all investors. It's not about stockholders. It's also about creditors, bondholders, maybe those who provided loans to a company. But definitely we don't want to take only stockholders. And that's why we do not subtract interest. Because interest must be there. Interest must be included in the cash flow in order to provide a full information. And this differs from, this is another difference that separates cash flow from accounting income. In accounting income, you subtract interest. In cash flow, no. Yes, accountants measure the profit available for stockholders. Interest expenses are subtracted, but we are talking about cash flows available for all investors, not only stockholders. So this was the part related to the cash flows. What are the cash flows? What are the elements of cash flows? And how we need conceptually to compute those cash flows. Now, if you remember, we spoke that what matters for investment project is relevant cash flows. Relevant means incremental cash flows. So what does it mean, incremental cash flows? They represent the change in the firm's total cash flow because of accepting the project. So basically you need to have two parallel worlds, two parallel universes. One universe where you don't do anything, you don't accept project, and your cash flows develop as is. Another universe is where you decided to apply to invest, and you have some other cash flows, and then you need to take a difference between the universe with the project and universe without the project, and that's would show you what we call incremental cash flows. And there are three special problems in determining these incremental cash flows. So first problem is sunk costs. So later I will explain you what is this. Second is opportunity costs, and third one is externalities. So those are needed to be taken into account when you estimate cash flows. So what are the sunk costs? Sunk costs are outlays that have already occurred and you cannot affect them by the decision. So if you decide to invest, if you don't decide to invest, sunk costs are not repairable. An example of this, not from investment projects, but from real life, might be the following. So suppose you purchased a ticket, cinema ticket. You really want to go there. You paid 500 rubles. I don't know what's the price of cinema tickets right now. But probably 500 is okay for students. You go to the cinema, and then at the front door you realize that you lost your ticket. There is no ticket. Now you have another decision. Either to insist and go to the cinema, or to give up and go home. So the fact that you lost a ticket and you paid for that lost ticket 500 rubles does not matter anymore. This is really important thing to understand. That past fact does not matter. Now you have another case of making a choice, and you need to make this choice based on the relevant cash flows. And relevant cash flows are either spend another 500 rubles or spend zero and go home. The same happens with companies. A company can make a research, market research, spend money on this before thinking whether to run a new investment project or not. If this is the case, if the company spent something before making a decision, those costs are not considered in the incremental cash flows. Only future costs that can be affected, not costs, only future cash flows that can be affected by our decision. Second, opportunity costs. What's that? Suppose you are not purchasing an equipment. Suppose you already have this equipment. You have a building, you have equipment, you have some technology, you already have it. Does this mean that your initial cash outlay is gonna be small? No. Opportunity cost is what you can earn under the current use of this equipment. Because, what does it mean? If you decide to move your equipment from one project to the other project, so the first project is gonna probably fail or gonna stop. Why? Because you are taking the resource which cannot be used by two projects, and you basically fail one of them. When you consider the when you evaluate a project that involves your own equipment, you need to include in cash outlays the possible profit from the alternative use of this property. And externalities. Externalities are the effects of a project on other parts of the firm. The most simple example is when you start producing a new version of a mobile phone, and the increasing growing sales of this new version would affect the negative growth in other projects. This is called the cannibalization. So when a new product kills the old ones, and you need to take this into account as a part of cost. For example, I start a production of a new mobile phone, but my firm already produces 2 or 3 other versions of a mobile phone. Those are older. When a new version would appear, it would immediately kill the sales of the old ones. And this difference should be taken as a cost of your product. This is an important thing. Now with this in mind, we can represent the cash flows chronologically. We already had it. I will just remind you. The items of cash flow, the typical items of cash flow. We start with the initial investment outlay, time t0, and there is some number with minus. So what this number is constituted from? The cost of fixed assets, initial investment in inventories, raw materials, fuel, maybe something else. The second element that we see, this is CF1, CF2, CF3, CF4, and so on. Depends on the lifetime of our project. So the second part is annual project cash flow. So here we compute this annual project cash flow as it was given before. Net operating profit after taxes plus depreciation and minus cash flows associated with annual delta of net operating working capital. And the third important element that is frequently forgot is terminal cash flow. This is extra cash flow generated from the salvage value of the fixed assets. So remember, when I spoke about fixed assets, I said that this is also possible to sell fixed assets at the end of your project. So this is extra cash flow generated from salvage value of the fixed assets and return of net operating working capital. So for example, if you close your project, there is no need anymore for the equipment, there is no need for raw materials, so you can sell it or you can simply transfer it to some other projects. But still, within this project, this delta is gonna be positive. I mean, the effect of this delta on cash flow. Okay, friends, I'm back. So let's have an example. How do we technically and practically compute and estimate the cash flows based on the following example? This is completely abstract example. So suppose that we want to produce um, whatever winter shoes. Suppose that we want to open the factory that is going to produce winter shoes. We expect that annual sales would be 20,000 units. Price is 3,000. Very cheap, but okay, so probably we produce Russian winter shoes valiantly, if you are familiar with this. So then the price is gonna be more or less reasonable. The annual sales, therefore, are estimated at 60 million rubles. So you simply multiply 20,000 units by 3,000 and you get this. So suppose that we don't expect growth in sales, so we will sell every year 20,000 units. And the unit price will rise by 2% each year. So let us start doing something with this. Let me show you how usually we do the following estimation. So for this, we necessarily work in Excel because Excel helps to build the financial model of an investment project. We need to put here some initial assumptions. So sales 20,000 units. Price 3,000 rubles per unit. Growth 0%. Inflation, right? Because this is an inflation is 2%. So we would put something else here in addition, but yeah, somewhere down there we can start building our forecast. So year 0, 1, 2, 3, 4. So let's do this for 4 years because later I will show you that we are doing this for 4 years. And we do the following. So unit sales. In year 0 we sell nothing, and then each year we sell 20,000 like this. The price, a unit price. Unit price, we start with 3,000, and then remember that this price increases every year by 2%. So next year it's 3,060, next year is 3,121, 0.2, and then next year it's this. So we can round this. So these numbers. Now sales. Overall sales or total sales can be computed as the product of two. So here we have the total sales. Good. In unit sales, we can basically implement the following thing also. We can take the previous year's sales multiplied by 1 plus growth rate. So if we are building the model, so the model must be versatile, and we need to be able, for example, if we expect now 3% growth, I can change this cell, and everything is going to be recalculated as we see here. So this is a nice feature of Excel. So total sales here, we can somehow mark it as the important part. And then we continue. So now we estimate manufacturing costs of 2,100 rubles per unit, variable manufacturing cost. And we also have a fixed overhead cost, which is 8 million rubles a year. So let's put them in our table. Variable cost per unit, 1,100 rubles. Fixed cost is gonna be total 8 million. 1, 2, 3. The variable costs are expected to rise by 2% per year. Again, the same inflation. Fixed costs are expected to rise by 1% per year, just to introduce some heterogeneity. So this is fixed cost inflation. 1%. Is that all? Yeah, so we have also tax rate. Tax rate. Okay, so let's assume that this is 40%, but it must be 20 if we are talking about Russian government. Yeah, let's assume 20, not 40. 20%. And cost of capital is 12%. So remembering the way how do we compute the net operating profit after taxes, we need to introduce here our cost. So this is not material cost, sales, salary, whatever. So the cost is represented in the form of variable cost and fixed cost. That's totally fine. So variable cost, let's write it unit variable cost, which is 2,100 the first year, and then it increases by 2% every other year. And then total variable cost might be computed as unit variable cost multiplied by unit sales. So here we are. Now we have total fixed cost, which starts with 8 million in year number 1 and then increases by 1% every other year. So, and then we can compute total cost, which is the sum of total variable cost and total fixed cost. So after, sorry, these are excluding depreciation, so it's not total operating cost. Yeah. So if we subtract total cost from total sales, we would get something which is called EBITDA. So earnings before interest, taxes, depreciation, and amortization. Total sales minus this. So now we need to sum information for depreciation. Let's see. Investment and net operating working capital. What do we expect about them? Purchase a building at a cost of 12 million rubles with a useful life of 39 years. So let's write this down here. Building 12 million rubles, not percent. So building useful life, 39 years, not percent, years. And equipment that is necessary, 8 million. Equipment cost 8 million rubles. And equipment useful life, 5 years. Yeah, the life of the project is 4 years. And we have some information about selling the equipment. Let's see. First of all, we can compute the depreciation. Somewhere aside depreciation. Let's call depreciation schedule for billion. We can write down something like this. Year 1, year 2, year 3, year 4, year 5, and that's all. So we don't need more. Here we have the purchase cost. It's gonna be always the same. $12 million. Then annual depreciation. Annual depreciation can be calculated as the purchase cost divided by the useful life of the equipment, 39. So the annual depreciation is going to be all the time, every time the same, like this. Now accumulated depreciation. So accumulated means that we need to sum this depreciation with all the previous depreciations computed. And finally, there is a book value. The book value that you will see in the balance sheet of a company. So this is the purchase cost minus accumulated depreciation. Yeah. Here. Yeah. Okay. Can reject this. So this is book value at the end of the year. Of course, we can continue doing this for 39 years, but it's not necessary. And the same we need to build for foreign equipment. Station schedule for equipment. So purchase cost is 8 million. Annual depreciation is computed based on this. And you see that everything is recalculated. By the end of year 5, we have 0. It must be written off. So now the total depreciation here is the sum of depreciation, annual depreciation in building and annual depreciation for equipment. So here we are. Now we have EBITDA, which is EBITDA minus depreciation. So this is the first important step in the cash flow estimation. Now one additional thing here related to the salvage value. So we see that the useful life of both pieces of fixed assets is longer than the project economic life. So that's why we can sell them. And here we have prices 7.5 and 2 million at the end of the 4th year. Yeah, so later on we will implement this as well. So this, we can call this forecasted of profit P&L statement. Now, forecast of cash flows. So remember that we said that usually we divide cash flows into 3 parts. So let's do the same. First of all, investment outlay. That was here. Investment outlay. Investment outlay. Everything happens in the first year. In the year 0, sorry. And we know that what is the investment outlay. This is building cost plus equipment cost. Must be taken with the negative sign. So this is the purchase, okay, investment outlay. So let me change it slightly. Purchase of fixed assets minus this and this. But we also said something that there is inventories, initial investment in inventories. So let's see what happens with inventories here. So a company must purchase raw materials and replenish them each year as they are used. We assume that the company must have an amount of net operating working capital on hand equal to 10% of the upcoming year's sales. So what does this mean? Let's build one more table here. Net operating working capital forecast. We need year like this. Sales, and we know what is the forecast of sales. And here we would have net operating working capital, which is 10% of sales upcoming years. Net operating working capital need, let's say 10%. Therefore, it must be taken up front. We take 10%, multiply by the sales of the next year. And that's here. And we also can calculate, oh, maybe not necessary, like this. So purchase of fixed assets is the first element of investment outlay. And the second element of investment outlay is investment in net operating working capital. So this is going to be minus this 6,000. So total investment outlay is the sum of these two. Nice. So we have this. The next element of a cash flow is annual project cash flow that is computed according to the algorithm. So let's look once again at the algorithm in order to compute and not forget everything. So we have a bit, it's here. And now we need to compute this free cash flow. So what do we need? NAPAT. Okay, so we can start with EBIT, which is here. Then we need NAPAT, which is EBIT times 1 minus tax rate. This one, 20%. Then what? Plus depreciation. So we need depreciation. Then there is a gross fixed assets expenditures, which are no. There is no gross fixed asset expenditures in either of these years, only here. And we have change in net operating working capital. And all this happens, right? Because there is a change. We need to compute this change. This minus this. And we have total annual cash flow. It computed as NAPAT plus depreciation minus change in net operating working capital. So the third part is terminal cash flow. So what is the terminal cash flow in our case? So we said that this is extra cash flow generated from the salvage value of the fixed assets and return of net operating working capital. So the return is already included here. We have it here with minus. We just need to compute the salvage value. Salvage value of building. Salvage value of equipment. This is very simple. We have a price. Where was it? Yeah, here 7.5 million for building, 2 million expected price for equipment. So we have price, how to say, price of building in the year for 7.5 million rubles. Price of equipment at the year for is going to be 2 million. rubles. Good. So the salvage value is computed as your market price minus taxes. So look, you are selling this at 7.5 million. So that's the money that you will get. But you need to subtract taxes. What are the taxes in this case? You have a price and you have at the end of the year annual book value here, 10 million. So you sold it at the price less than book value. So there is a loss for you. If there is a loss, this loss can be, you can reduce your taxes by the size of the loss. So therefore I'm taking this minus this book value multiplied by the tax rate here. And the same happens for the next piece of fixed assets. So here, how this 1,600,000 is received. No, it's wrong. So we take 2 million. That's the money that we are going to get. And we need to subtract the taxes. So taxes are 2 million for selling price, and here is the book value. So we need to subtract this from the selling price, multiply by tax rate. And your residual amount is here. So you need to pay taxes in the nutshell. When you sell an equipment, you need to pay taxes. And the taxes are computed as the difference between selling price and book value multiplied by the tax rate. That's simple. So the total salvage value in this case is going to be the sum of these two things. So now we can calculate the total free cash flow. What's that? We take total investment outlay plus total annual cash flow plus total salvage value. Here we are. So this is exactly the cash flow that you see when you compute net present value, payback, and all the other things. So for example, now we can compute net present value. So for this, we need to compute present value first. So we take this divided by 1 plus cost of capital. It's here to the power of the period number. Got it. So what is the net present value? And PV is the sum of these things. Simple rubles. So it's 10,550,661. So NPV is positive, therefore the project can be accepted. Now we can compute internal rate of return with the help of Excel formula. Taking this, and so this is 27%. So IRR is greater than cost of capital, 12%. Again, the project can be accepted. Well, we can compute payback, we can compute other criteria if needed. That's not an essential part. So again, you see that the estimation of cash flow involves a lot of calculations. All those calculations are based on very simple logic of financial accounting that you are supposed to be familiar with. And of course, in practice, the most important part is to come up with these numbers. All those numbers. How to estimate your expected sales, how to estimate the expected inflation, all those things, they are really, really important and very difficult. And so, well, in practice, usually the forecasts are not met. So the actual values might be different. So I will store this for you. Cash flow estimation. So this was about the most important step in the project valuation. So how to compute NPV, it's just one formula. How to build an estimated cash flow, it's a huge procedure involving a lot of professionals, departments, and a lot of competence. We need to always use relevant cash flows, as I said, only cash flows that are connected to your investment decisions needed to be taken into account. Your home assignment after the lecture. Home assignment number 7 on the course page, that is going to be based on our exercise session with the computation of modified internal rate of return, NPV, comparison of independent and mutually exclusive projects. And for the next exercise session, as usual, I will be asking questions on this lecture, not lecture 7, not lecture 6, not lecture 5, about this lecture. Please be careful. Watch the video, read the slides, look at the spreadsheet where we estimated cash flows. So next exercise session, I will be asking questions about this material. Questions?
No question. Thank you, Professor.
Okay, so then you will be able to find the video after the lecture, and we will meet each other next week. See you guys. Bye-bye.
See you, Professor.
Thank you for